This has been a great week. The Fed made an announcement, the market corrected, people freaked out, crazy stuff is going on in China. But the thing is, does any of it matter? Even better, which sectors are liking the news, which sectors are hating the news, what stocks are going up, which ones are going down. We're going to get to all of that. Stick around. Hey guys, this is RC Peck, and there's a lot going on this week, but is there too much? Is there not enough? People are being taught to look in the wrong areas, and that ends up hurting their portfolios. So what I want to do is talk about what is working, what sectors are liking, segments are liking the Fed's news coming out about raising interest rates, possibly in 2022, cutting back some of the money printing. So we want to know what is working, what sectors are liking it, what sectors are not. Let's get into that. So what I want to do is jump over to the chart. So let me do that. So here we are on the chart. So let's first talk about the best S&P stock of the year. I know what you're thinking. It's probably Bath and Body Works. I know, right? Bath and Body Works. It's beating everything in the S&P this year. It's up about, and let's just see what it's up about. It's up about 120%. Pretty good for an S&P stock, right? Those are kind of the boring things. So those are the things that pick of the month newsletters say, if you buy an average, you're going to get an average, and the S&P's an average. What a bunch of crap. So we've got a stock that is breaking up. It is beating almost everything. No one's talking about it, which is great. And you can see it on the screen here. Let's do this. Let's give you a little bit better view. Let's clear some stuff here. And so this is what we have. We have a super boring Bath and Body Works stock moving higher. And this is the great thing about investing. Who would have thought that one of the best stocks in 2021 was a Bath and Body Works stock? But there it is. It's beating the S&P 500, all the other stocks in it. Not bad considering no one's talking about it. I'm sure there are no newsletters talking about it, but here we are with Bath and Body Works. It's BBWI. It's moving higher. So it did like the Fed announcement. Let's then move to one of the best one of the most well-known fund managers of the last 18 months. And this would be Cathie Wood. She is running ARK Innovation. This is actually ARK Innovation's flagship fund. And basically it's down for the year about 5%. So it's really, really underperformed. It's at the same price it was basically December of last year. So it's done nothing for 10 months. Now, here's the thing. It became really, really popular at the end of 2020, beginning of 2021. And so I'm willing to bet most people who have actually invested in ARK are actually down. There's very few people who are in it in 2018 or 2019. If you look on the screen here, way back down here, there weren't that many people in it. So I'm willing to bet most people who are in ARK are actually down since buying it. The other thing that's really interesting is because people are taught to over diversify, what I often find is people own 3, 4, 5 of the ARK investments thinking they are diversified, but they're actually not. All of those funds are over the same amount of time period. And if you look at those funds on a price chart, they all go up and down together. Guys, that's over diversification. Don't do it. Okay, so what segment of the market really liked the Fed saying, we're probably going to raise interest rates, we're probably going to stop printing? What segment or sub-segment liked it? And the answer is good old regional banks, guys. Remember those? They have been a pretty tough place to be this year ever since, call it mid-March. You could maybe extend that to mid-May. But here's the go-no-go zone. Really, KRE, which is a tracking symbol for regional banks, you got to be above $65. And it is. And regional banks really love that, meaning banks like the idea of higher interest rates because they can charge more on their loans. And then, of course, KRE is part of XLF, which is the sector, the financial sector. That looks great. The financial sector looks great. So the financials are liking what the Fed is talking about, both the overall sector and that little smaller segment in it called regional banks. So that's pretty cool. Okay, now we need to talk about who didn't like the announcement. And who didn't like the announcement was basically safe equities. So here on the screen, you have utilities. Didn't like that announcement, right? They didn't like the idea that yields rates may be going higher. That's going to affect utilities. And so you can see it didn't like. Now, utilities tried to, they really, seriously, guys, they really tried to break out to new lifetime highs. And they did it for 4 weeks. And then now they're back below. So really, you can't really own utilities unless they really get above that kind of that blue line zone and stay above it, but it is not happening. So as of right now, the safe part of equities, and that could be XLU. Let's just quickly look at really S&P low volatility, also did not like it. And let me just quick see. I mean, look, consumer staples are going up, but they did not like the announcement. So this is good news for people who are long the stock market or believe or want the stock market to go higher. And that is the places that people usually hide when they get scared while staying in the stock market, they're not hiding in it. The other thing is just looking at the overall bond market, US bond market, BND. It's in a tight channel. There's not a lot going on with this segment, this asset class is exactly where it was in July of last year. So bonds really haven't done anything. And the fact that they're not going up means people really aren't scared. Okay, now here's the last thing I want to talk about. And this is the asset. There's, depending on how you want to measure it, 4 assets on the planet or 5 assets. Stocks, bonds, cash, currencies, if you're doing 5, commodities, and real estate. So which of those 5, and no, crypto is not a new asset class. Crypto has currency in it. I said currency third. And it has companies in it, which they're not calling them companies. They're not calling them IPOs. They're calling them projects. They're not calling them stock. They're calling them coins. They're the same thing. So the asset that is loving what the Fed is doing is commodities. So look at commodities here. As a asset class, it is liking it. It had to get above. Now I'm looking at a tracking symbol, DBC, but DBC is about to make, and we can zoom out, a new 7-year high. I mean, commodities have been out of favor for a long time, over a decade. They've woken up. If you look at the screen here, this is absolutely a clean out. If I show you the commodity index here, CRB, and I do a way zoom out here, let's just go out 30 years. You can see what happened. There's this crazy clean out up here, and there's a crazy clean out here. And the main thing commodities really had to do is decide, are you going to go above or are you going to go below? And what they did was they went below, scared the hell out of everyone, and now they're back above. And commodities got a lot of space, got a lot of fresh air in front of it. They are moving higher. This asset class is loving what the Fed is doing. It's loving what's going on. Whether inflation is transitory, not transitory, do you include, do you not include? I've looked at the CPI. I've stopped trying to figure out what they're doing and how they're cajoling it and changing it and torturing it to get to stay as low as they are. Bottom line, you have your own inflation rate and you have your own assets. Your assets have to be growing faster than inflation, then you're fine. And if you're in the stock market, that's absolutely been happening. So what did we learn? Let's just finish this up by just kind of, pulling up SPY, and we'll tighten this up. That's 30-year price chart. We can just go back. Let's go back here. So let's tie this up. Market's going higher. Stocks were not put off by the Fed's remark. Barely, not even a 5% correction in the market, and everyone's freaking out. That Evergrande thing that's happening, I think it's kind of a funny name, happening in China, no one really seems to care. The market's going higher. Even if we bring up China here and we bring up a price chart of China, it looks like it's moving higher. This thing was priced in, fully priced in, $300 billion deficit. Apparently, China's going to figure out how to manage that because China is basically managing everything in China. They're not allowing people to get too rich anymore. That's why you have, let's say, the Chinese NASDAQ, which is CQQQ. This is why it's looking really bad here. So stay away from China. Yes, it can revert back to its mean. It's not doing it right now. It seems like they're increasing their manipulation. I'm sorry, adaptation, whatever it's called in China. I would stay away from China right now. So that's what we have going on right now. There is a lot going on, but the price charts give us the answers. Understanding where the signals are, understanding how to read strength. Price was the first thing. It's really going to help you keep your focus on the right things. Thanks, guys. If you like this video, please like it. Click one of those buttons. Leave a comment. It really makes a difference. It helps me out. So I appreciate that. And if you like this, you're going to love our free course. Just click in the description below, expand it, and you can see all that you want about the clarity and control, how to get clarity and control back over your money. Thanks, guys, for being in my world. I do appreciate you. Leave some comments. I read them all. I reply to them. And I'll see you on the next video. Okay, bye.